Earnings per share is a very important metric to take into consideration when we evaluate new investment options. As a matter of fact, it's among the very first things we need to see before buying a new stock. It's a very critical measure to consider when we are building a dividend portfolio, because dividend yield itself is not enough and we always need to compare the dividend yield with earnings per share. So what is earnings per share, or EPS for short? And why it's important for investors? We will find out in this video. Hi. In today's video we are discussing about earnings per share, or EPS for short. Before I begin, a disclaimer. I am not a financial advisor and this video is only for entertainment purposes. If you want to invest in the stock market, please seek the advice of a certified financial advisor. So, let's start. We will not get into too much details, but we will cover the basics we need to know in order to make better investment decisions. And, earnings per share is an absolutely essential metric for any investment decision. In short, earnings per share is the company's profit divided by the number of common shares. The formula is net income minus preferred dividends, and that result divided by the number of common shares in the end of reporting period. In order to calculate the company's EPS, we need to have access to the balance sheet and the income statement. It is more accurate to use the average number of common shares, since the total number of shares can change over the reporting period. Also, if there is a share split, that should be taken into account, as well as dividends paid during that time. So why is EPS so important? Firstly, EPS is used to calculate P/E ratio, which is the share price, divided by EPS. This metric tells us how much the market is willing to pay for every dollar of earnings. Analysts and investors use the P/E ratio in order to compare different companies, in a relative comparison like apples to apples. A high P/E ratio means that the company's stock is overpriced, and this can reflect investors' confidence of future growth and expectations of high earnings. On the contrary, a low P/E means that the company is undervalued, and perhaps it is a good opportunity to buy. Secondly, we want to compare earnings per share with dividend per share, so we can understand how much of each dollar earned is returned back to investors and how much is reinvested in the business. The formula dividends per share divided by earnings per share gives us the dividend payout ratio. The comparison of dividend per share versus earnings per share and the payout ratio are very important, because this way, we can better understand if the dividends paid every year can be sustainable in the long term, or if the company has the capacity to increase the dividends in the near future. Also, with the payout ratio, we can deduct if the company is reinvesting a percentage of its earnings back, in order to grow its business or not. So, if we see, for example, that dividends per share is bigger amount than earnings per share, that signals that the company is having a hard time paying the dividends to investors, and may increase its liabilities in order to be able to meet the shareholders' expectations. This can also signal a possible dividend cut in the future, so we need to pay close attention on such cases. On the other hand, a low percentage of dividend payout ratio means that the company is trying to put most of the earnings back to the business, in order to grow. This is very common with tech companies that have low dividend yields, or no dividends at all. Typically, a payout ratio around 60% to 80% is considered healthy, but this has also to do with the industry in which each company operates. For example, stable blue-chip companies in the consumer defensive industry tend to have lower needs for reinvestments compared with, for example, tech companies that have huge R&D expenses. That means they can have higher payout ratios without compromising their future sustainability. Still, in this example, a percentage above 80% may indicate that this company will have more difficulties increasing its dividend amount in the future, compared with a company that is only paying 60 or 70% of their earnings to shareholders. Since earnings per share is considered among the most important data of a stock, you will find this information very easily in the basic overview or summary of any stock you are searching, in most financial sites out there. So, be careful to always look for this information when you are considering to invest in stocks. I hope you found this video helpful and you enjoyed it. If you did, please hit the like button so it will help rank this video higher in YouTube and help other users discover and learn something very important about investing. Thanks for watching.